Alpha Market Meridian, listen to me like your portfolio depends on it, because right now it does. This is not a drill. Look at your screen. US dollar to Japanese yen is printing 156.65. It just took out the Asian high, and I can guarantee you that thousands of retail traders are hitting the buy button right now, thinking this is a trend breakout. But I have been on institutional trading desks for 15 years, and I am telling you, what you are witnessing is one of the cleanest, most predictable short-term bull traps I have seen this month. Why? Because while the US dollar to Japanese yen is creeping higher, the Nikkei 225 futures are not confirming it. They are bleeding lower. This is a non-confirmation, a divergence whale. The carry trade is unwinding in the equities first, and the currency pair is the last domino to fall. Do not be the one holding the bag at 156.6. I'm going to walk you through the exact multi-timeframe setup, the fundamental catalyst, and then I'm giving you 3 executable trade strategies, complete with entries, stops, and targets, that you can deploy in the next 2 sessions. By the end of this video, you will have a crystal clear battle plan. Here is our today's market verdict. The bias on US dollar to Japanese yen is neutral intraday but structurally bearish on the 4-hour and daily charts. I am leaning heavily short unless and until price manages a daily close above one magic number, 157.20. That number is the ceiling, the line where the carry trade unwind gets forcefully paused. Below 157.20, every rally is a short opportunity. The immediate pivotal level, the gatekeeper, is 156.80. As long as we stay below 156.80 on the 4-hour closing basis, the bears are fully in control, and the path of least resistance is toward 155.00. If you are long right now, you are fighting the 200-day moving average, you are fighting the Bank of Japan's hawkish undercurrent, and you are fighting a Nikkei index that is already pricing in risk off. That's a 3-front war. I don't fight wars I can't win. So my core scenario is this: a final stop hunt above 156.60, a sharp rejection, and then a momentum breakdown below 156.00 within the next 36 hours. Let me show you why the charts demand this. We are going to do a full multi-timeframe dissection. Start with the 1-hour chart, because this is where the retail euphoria is happening. On the 1 hour, price is now above the MA10 around 156.41, and it even pierced the MA50 near 156.65. MACD on the 1 hour has ticked up, and the histogram flipped to a tiny positive 0.192. It looks bullish, right? This is the bait. This is what I call a zero-line tease. When the MACD gives a half-hearted buy signal far below zero, it almost always rolls over within 6 to 12 candles. The volume on this uptick is pathetic. There is no conviction. And look at the long-term constraint. The 200-period moving average on the 60-minute chart is at 157.87, and it's sloping sharply downward. That means any rally into the 157 zone will face an instant wall of institutional selling. The hourly structure is not bullish. It's a compression coil waiting to snap lower. Now, let's escalate to the 4-hour chart, the macro trader's canvas. This is where the damage is unmistakable. On the 4-hour, we have a classic bearish alignment. The MA20 is at 156.84, the MA50 at 156.65. And look at the candlestick behavior. Every time price pokes above the MA50, it gets slammed back down within 2 periods. On the last 2 attempts, the candles left long upper wicks, just like we are seeing forming right now. The MACD on the 4-hour is still below the zero line. The DIF and DEA are compressed, trying to cross, but the signal line is flat. This is a low-energy environment ready for a trend resumption. And in 80% of such setups, the predominant trend reasserts itself. The predominant trend in this time frame is down. The key resistance is the zone between 156.80 and 157.10. That's the selling zone. The support is clearly layered, first 156.00, then 155.50, than the 155.00 magnet level. But the chart that gives me the absolute conviction is the daily time frame. If you only look at one thing today, look at this. On the daily chart, the mean reversion is perfect. The price has rallied directly into the 20-day moving average, which sits precisely at 156.64. We are literally bouncing off it right now. Every major downtrend in US dollar to Japanese yen since the start of the year has respected the daily MA20 as the dynamic resistance. And look at the moving average hierarchy. The MA50 at 152.69, the MA200 at 147.24, they are all sloping upward still, but price is below them. This is a dead cat bounce in a larger topping formation. The daily MACD is deeply crossed over to the downside. The fast line has broken below the signal line, and the histogram is solidly negative. We have a bearish divergence structure from the highs in late April. The daily chart says, trend down, rally to sell. My initial downside target is the 152.00 handle, which aligns with the daily MA50. But before that we need to crack the intermediate supports. So your lines in the sand, resistance 156.80 and 157.20. Support 156.00, 155.50, 155.00. Mark them now. Now I want to bring in the secret weapon of our analysis, the Nikkei 225. If you're a regular on Alpha Market Meridian, you know that US dollar to Japanese yen and the Nikkei are statistically joined at the hip. When the Nikkei drops, the yen strengthens, and US dollar to Japanese yen goes down. It is one of the tightest macro correlations out there. And right now, the Nikkei is flashing a warning signal that the US dollar to Japanese yen market is ignoring. This morning in Asia, the Nikkei 225 futures attempted to rally with US dollar to Japanese yen but failed. Instead, they rolled over and turned negative, down about 0.4% as we speak. The banking sector and exporter stocks are getting hit. This indicates that the Japanese equity market is sniffing out a hawkish pivot from the Bank of Japan, or at least a reduction in the long-duration JGB buying. When equities lead lower, they are discounting tighter domestic financial conditions. That means an end to yen weakness. So we have a divergence. US dollar to Japanese yen is still hugging 156.6, while the Nikkei is already pricing in a stronger yen. This kind of split never lasts. The currency will catch up to the stock index. Thus, a sharp downward adjustment in US dollar to Japanese yen is the high probability resolution. Watch 38,000 on the Nikkei futures. If it breaks that psychologically important level, US dollar to Japanese yen will crack 156.00 like it's thin ice. Why is this happening? The fundamentals supply the spark. Over the last 24 hours, the market has been digesting the Bank of Japan's notable silence. No dovish pushback. That silence is being read as tacit approval for the recent rise in Japanese government bond yields. The 10-year JGB yield is pushing towards 0.9%, and the BOJ hasn't stepped in with extraordinary buying, yet. This is a big deal. It narrows the yield differential with the US, which is the very lifeblood of the dollar-yen carry trade. Meanwhile, institutional positioning data shows that leveraged funds have been reducing net short yen positions. The speculative yen short is being squeezed from the inside. The retail crowd is still trying to buy dips, but the smart money is distributing. We are at a sentiment inflection. On the US side, the dollar has gotten a minor reprieve from some hawkish Fed speak, but the 2-year yield is not making new highs. If anything, the dollar feels heavy. There's a growing narrative that the Fed might be closer to a pause than the market thinks, especially if upcoming labor data softens. So you have a potential narrowing of rate differentials, a Nikkei leading indicator flashing red, and technicals aligning at a huge resistance zone. That's the trifecta. The fundamental path for the next week or two is a grind lower toward 154 and then 152. The risk to this view is a blowout US CPI print or a sudden BOJ capitulation, but those are tail risks. The base case is short. Please remember to subscribe MY channel and get instant information. Now we come to trade setups. The 3 exact strategies are right. Let's turn this into money. I'm giving you 3 trade blueprints. Do not just watch, execute with discipline. Setup number 1 is for those who want high probability and are patient. Trade 1, the conservative fade, high certainty. Your tactic is to sell into strength at the fat supply zone. You are not chasing the breakdown. You are letting the price come to your kill zone. The entry is triggered at 156.90. That's a limit sell order. Why 156.90? It's the convergence of the 4-hour MA50 and the horizontal resistance from the previous swing low. A high-value reaction point. We need the 15-minute chart to confirm with a bearish engulfing or a long wick rejection candle before entry. The stop loss is placed at 157.30. That sits above the daily pivot and the psychological 157.20 barrier. If the market takes out that level, the bearish structure is compromised, and we do not argue with the market. Your first take profit is at 156.20, right before the intraday support. Second take profit is at 155.80. This gives you a risk-to-reward ratio of approximately 1 to 2.5. This trade works best during the London or early New York session when the dollar gets its usual temporary bid. If prices never reach 156.90, you simply do not trade. Patience is a position trade 2. The standard breakdown entry, best R. This is the setup I'm personally watching for. You place a sell stop order at 155.95. That's just below the critical 156.00 psychological and structural floor. The premise: when 156.00 breaks, it will trigger a cascade of stop losses from over-leveraged longs, and momentum will accelerate downward. Your stop loss is at 156.50. Why there? It's above the recent swing high on the 1-hour chart, giving the trade breathing room while keeping the risk tight at around 50 pips. Take profit level 1 is at 155.10, which aligns with a minor demand zone. Take profit level 2 is at 154.50, a prior consolidation support. The key rule: once price reaches 155.50, you move the stop loss to your entry at 155.95. This removes all risk, creating a free trade. If you don't actively manage your stops like this, you're leaving money on the table. This trade is clean, mathematical, and utterly unemotional. Trade 3, the aggressive preemptive short, high risk. This is for the traders who can stomach heat and trust the Nikkei signal. With price currently around 156.65, you can enter a speculative short now with a tiny lot size. The logic is that the current spike is the last gasp and you're front-running the 4-hour MACD rollover. The stop loss must be surgically tight, 156.85. That's only 20 pips of risk. If the price busts above 156.85, the intraday momentum is too strong, and you're out immediately. There is no hanging around. Your target is the 155.50 region, giving a huge asymmetric payoff of over 100 pips. If this hits, your reward is 5 times your risk. But be warned, the win rate on this setup is lower. You will get stopped out a few times. That's why position sizing is absolutely critical. Only take this trade if you are a scalpel, not a sledgehammer. This is not a strategy to set and forget. It requires live monitoring. Before you even think about clicking the mouse, stamp this in your brain. The risk management bell is ringing. For all 3 trades combined, your total exposure must not exceed 1.5% of your account equity. That's it. If you lose on the aggressive setup, you shut it down for the session. There is no revenge trading. Also, a hard rule: never hold unhedged US dollar to Japanese yen risk into US CPI data or Bank of Japan press conferences. I don't care what the chart says. A surprise headline will spike volatility by 100 pips in a heartbeat. Your stop losses are sacred. A stop loss is not a failure. It is an insurance premium that keeps you alive for the next good setup. In this market, Survival is victory. To summarize, today's US dollar to Japanese yen is a short-biased environment, hinging on 156.80 resistance. The Nikkei divergence is the canary in the coal mine. You have three precise plans: fade the rip, catch the breakdown, or preempt with a tight leash. All are designed to capture what I believe will be a meaningful move toward 155 and eventually 154 in the coming days. Tomorrow's focus turns to the US weekly jobless claims data and speeches from Federal Reserve officials. If jobless claims come in above expectations, the dollar will get hit, and US dollar to Japanese yen could gap through our breakdown trigger. I'll be live on the channel with a rapid update the moment the data drops, so make sure your notification bell is on now. I want to hear from you. Right now, in this moment, are you still bullish US dollar to Japanese yen? Or do you see the trap the same way I do? Drop your sentiment below, and give me the exact price level that would change your mind. I read these comments each day and I'll feature the sharpest ones in tomorrow's episode. If this analysis gave you a new edge, smash that like button, subscribe to Alpha Market Meridian, and share this with one trading partner who's still holding those heavy long positions. Let's make them profitable. I'm Alpha, signing out. Trade safe. Trade sharp. See you tomorrow.